A lot of Americans thought the job market was finally stabilizing. But over the past few months, more companies have quietly started cutting workers again. Not always with huge headlines, not always with dramatic announcements. Sometimes it is smaller layoffs, hiring freezes, reduced hours, delayed bonuses, and I think many families are starting to notice the pressure building underneath the surface. One recent report showed announced layoffs rising compared to last year, especially in technology, finance, retail, and manufacturing. And when layoffs begin spreading across multiple industries at the same time, businesses usually become much more cautious about the economy ahead. In the next few minutes, I am going to break down what this means for your money, what could happen next, and what I would personally pay attention to right now. A few days ago, I was reading about a man named David. David is 42 years old. He lives outside Columbus, Ohio. He works in supply chain management for a manufacturing company, and he earns around $78,000 a year. For most of the past 2 years, he actually felt relatively secure financially. His company was still hiring, overtime was available, raises were smaller than inflation, but work still felt stable. Then things started changing quietly. First, the company paused new hiring. Then travel budgets were cut. Then management started talking more about efficiency. And recently, about 15 people were let go across several departments. Not massive layoffs, but enough to completely change the mood inside the company. Now David and his wife are delaying home repairs. They cut back restaurant spending. They are watching every grocery bill more carefully. And they are trying to build a larger emergency fund because they are no longer confident things will stay stable. I think that story probably sounds familiar to a lot of people right now. What makes this situation difficult is that layoffs do not always happen during a full recession. Sometimes businesses simply become nervous about future demand. If consumers spend less, borrowing costs stay high, and profits tighten, companies often react early by reducing payroll expenses. And payroll is usually one of the biggest company expenses. A lot of this connects back to interest rates staying elevated longer than many businesses expected. Higher borrowing costs make expansion more expensive. Companies delay projects, hiring slows, investors demand stronger profits, and eventually workers feel the impact. Before I go further, this is not financial advice. Everything here is purely educational, and you should always speak with a licensed financial professional about your own situation. There are 3 important things I think you should pay attention to here. The first thing I would pay attention to is how layoffs are spreading beyond the tech industry. For a while, many people assumed layoffs were isolated to large technology companies. But now we are seeing cuts expand into banking, logistics, healthcare administration, media, retail, and manufacturing. One labor report recently showed job openings falling by more than 1 million compared to earlier highs. And that matters because fewer openings usually mean workers have less flexibility if they suddenly lose a job. This matters more than most headlines are suggesting. When hiring slows broadly, even workers who stay employed often feel pressure. Raises become smaller, promotions slow down, companies reduce overtime hours, and employees become more cautious with spending because uncertainty itself changes behavior. One practical thing I would personally do right now is organize and update my resume before I actually need it. A lot of people wait until after layoffs happen, and by then stress levels are already high. And unfortunately, I think companies may continue moving carefully through the rest of the year. The second thing I would watch closely is consumer spending. About 70% of the American economy is tied to consumer spending. So when families start pulling back even slightly, businesses notice very quickly. Right now, more households are carrying higher credit card balances than they were a year ago. And many consumers are spending more money on essentials like housing, insurance, and groceries. That leaves less room for everything else. Think about what that means over a full year. If millions of households reduce restaurant visits, delay vacations, or avoid larger purchases, businesses start earning less revenue. And when revenue weakens, companies often look for ways to cut costs. Usually payroll becomes part of that conversation. I think this is the part many people are underestimating. Layoffs themselves can create a ripple effect. One family cuts spending, then local businesses see weaker sales, then those businesses become cautious too. One practical step I would take here is reviewing recurring monthly expenses. Small subscription charges and automatic renewals add up surprisingly fast when economic conditions tighten. And this is where the ripple effects start showing up. The third thing I would pay attention to is how long interest rates remain elevated. A lot of businesses expected rate cuts much sooner. Instead, inflation has stayed stubborn enough that the Federal Reserve continues sounding cautious. Higher rates affect almost everything. Business loans cost more. Commercial real estate becomes harder to finance. Credit card interest stays expensive. And companies become much more selective about hiring and expansion. One important number here is that average credit card interest rates are still sitting near record highs for many borrowers. That means households already carrying debt are under more pressure each month. And when consumers feel squeezed, businesses feel it too. One practical action I would consider is focusing on paying down high-interest debt faster if possible, even in small amounts. Reducing interest expenses creates more flexibility if the economy weakens further later on. At least right now, businesses seem less focused on aggressive growth and more focused on protecting profits. Now, here is how I personally look at all of this. I do think the economy is entering a more cautious phase, not necessarily a severe downturn, but definitely a period where companies are becoming more defensive financially. What concerns me most is not one giant economic event. It is the combination of smaller pressures happening simultaneously. Higher borrowing costs, more expensive insurance, slower hiring, persistent inflation, and rising consumer debt. Individually, each issue feels manageable. Together, they create financial stress for a lot of middle-income households. But I also think it is important not to panic. The labor market is still stronger than it was during past recessions. Many companies are reducing hiring instead of making massive cuts, and households that prepare early usually handle uncertainty much better. I would focus more on flexibility than fear right now. First, I would personally build or strengthen an emergency fund, even if it starts small, because layoffs often happen with very little warning. Second, I would review monthly spending carefully and look for expenses that no longer provide much value, especially recurring subscriptions. Third, I would check my credit score and overall debt situation, because borrowing becomes much harder during slower economic periods. Fourth, I would avoid making large, unnecessary purchases right now unless they are truly needed, simply because job uncertainty appears to be rising. Fifth, I would stay informed without obsessing over headlines, because constant fear-based media coverage can push people into emotional financial decisions. The people who stay informed and make small adjustments early usually handle periods like this much better than the people who ignore it completely. What we are seeing right now is not just about a few companies cutting jobs, it is really about businesses becoming more cautious with money overall. We talked about layoffs spreading into more industries, how weaker consumer spending can create broader economic pressure, and why high interest rates are still weighing heavily on both companies and households. And I think the next several months will probably tell us a lot about where the economy is heading from here. If this helped you understand what is happening a little more clearly, subscribe.